This video covers impairment of intangible assets other than goodwill. An impairment is a decline in the carrying value or book value of an asset. Impairment is also referred to as a write-down or a write-off. Companies record a journal entry for impairment when the future cash generating ability, or we might think of this as the amount of revenues that intangible asset is expected to bring in the future periods, is less than its current carrying value. Why might an asset's carrying value be higher than the sum of its future expected cash receipt or revenues? Here are just a few bullet points of factors that might lead to impairment. A significant adverse change in legal factors or in the business climate, a significant adverse change in the extent or manner in which the asset is used, and or a projection or forecast that indicates losses or reduced profits associated with an asset. The journal entry to record impairment, we'll write this down in a minute, but we're going to debit the account loss on impairment. That's reported on the income statement. Typically, it's going to be in the other expenses and losses section outside of operating income. Although at times, if it's happening often enough for the company, they're recording impairment entry often enough, they might include it as part of operating income. We credit the specific intangible asset account. So if we are recording an entry for a patent, we debit loss on impairment and credit the patent account. Let's take some notes on this. So again, an impairment is a decline in the carrying value. We can say a decline in the value, but what we care about as accountants is the value on the balance sheet of an asset, or book value, often referred to as carrying value. A decline in the value of an asset. Often an impairment is often referred to as a write-off or a write-down. And we are interested in learning the accounting rules for when do we need to record an impairment and how do we do it. Well, there's two sets of rules. One is for impairment of limited life intangibles. Remember, we said that patents can have a legal life of 20 years, but the useful life might be shorter than that. A franchise might be set up with a specific limited life, or it could be an indefinite life. Copyrights, 70 years plus the remaining life of the creator. So the impairment of limited life intangible assets. It's a two-step process, and the first step is called the Recoverability Test. By recovery, we mean, are we going to get as much cash as this asset is worth on the books? And here's the recoverability test. If the expected future net cash flows, the reason that we would buy a patent or trademark, a franchise, a license, is it because we expect it to bring us future revenues. So if those expected future net cash flows or revenues from the asset is less than the carrying value of the asset. So we're not going to get, if we think we're not going to get as much cash from this asset than it's actually reported at on the balance sheet, so less than the asset's carrying value or book value, then the asset is impaired. But we're not done there. The amount of the impairment is not equal to the difference between the expected future cash flows and the asset's carrying value. Step 2 is called the fair value test. So the amount of the impairment loss is the amount by which the asset's carrying value, or the value on the balance sheet, exceeds. So in step 1, recoverability test, we said the carrying value, by how much does the carrying value exceed expected future net cash flows? Now we compare it to, what is the asset worth today? If we were to buy a patent for that exact same item, what would we have to pay? And how does that differ from expected future cash flows? We're talking about amount today is the present value. So what's the difference between the sum of future net cash flows and present value? We have to take these future net cash flows that we see here and discount them, take the present value of those future net cash flows. And we call this the fair value. What is it going for today? Okay, so step 1, compare the sum of future net cash flows to carrying value. Step 2, compare carrying value to fair value. Let's take a look at an example. Lurch Inc. has a patent on how to extract oil from shale rock. Unfortunately, several recent non-shale oil discoveries adversely affected the demand for shale oil technology. As a result, Lurch performs a recoverability test. It finds that the expected future net cash flows from this patent are $35 million. Lurch's patent has a carrying amount of $60 million. Discounting the expected future net cash flows at its market interest rate, Lurch determines that the fair value of the patent to be $20 million. We see the instructions here perform the recoverability test, but then let's also go into the next step, perform the fair value test, and then if impairment is needed, record that journal entry. So for example 1, let's write down the information that we have here, the expected future net cash flows, $35 million, the carrying value, $60 million, and the fair value of the asset is $20 million. True or false, the fair value will always be less than or perhaps equal to the expected future net cash flows. That is true. The discount rate can never be negative, so it could be very, very small, whereas the expected future cash is equal to, but almost always we will see positive discount rate, meaning that the fair value will be less than the expected future net cash flows. Okay, so the recoverability test is step 1. The future cash flows, let's compare those to, so we're saying that this patent on the technology of $35 million, it's going to bring us $35 million in the future, ignoring the time value of money. Compare that to the carrying value. On the books, we're saying this asset is worth $60 million. Is that a problem if what we say on the balance sheet is worth $60 million is only going to bring us $35 million, not even accounting for time value of money? Yes. So this asset impairment is indicated. So because the future cash flows is less than carrying value, asset is impaired. And we go to step 2. If the asset wasn't impaired, if the carrying value was $30 million, we can just stop here and say no impairment is needed. We've checked, continue on. Okay, but impairment is needed, so we go to step 2, which is the fair value test. And that's where we compare the difference between the carrying value and the fair value is the amount of the impairment. Carrying value is $60 million, and subtract from that the fair value. And that's the amount by which you want to reduce the carrying value. What we're doing with the fair value test is saying, once we book our entry, let's make the carrying value equal to the asset's fair value. So the fair value is $20 million. So that difference is the amount of the impairment of $40 million. And so the journal entry that we would need to record the impairment on the asset, bring the patent down to its fair value, we debit loss on impairment for $40 million And we credit that specific intangible asset account. In this case, it's a patent. Bring that patent's value down 40 million. So after this entry is recorded, what is the asset's carrying value? The patent is reported on the balance sheet. It has a carrying value of 20 million. Because it started the period at 60 million, we just reduced it by 40 million. So the carrying value will be 20 million. Next, let's take a look at what are the rules for impairment for intangible assets with an indefinite life. Impairment of intangibles with an indefinite life, we ignore the recoverability test and we simply go to the fair value test. And here we have an example. Before we get into the example, let's just write down our notes here. For impairment on an indefinite life intangible asset, remember, with an indefinite life intangible asset, we expect that it's going to bring us future cash flows forever. Okay, so we have no recoverability test. We skip that first step. And the reason why is because if we assume that this asset is going to bring us cash forever, really, in most cases, we would never fail the recoverability test, but that doesn't mean that the asset will never be impaired. So no recoverability test, go directly into the fair value test. Okay, so let's go back to our example. Same fair value test that we used before. So let's take a look at our example. Archon Radio purchased a broadcast license for $2 million. Archon Radio has renewed the license with the FCC twice at a minimal cost. It expects to find the cash flows to last indefinitely, so the company reports the license as an indefinite life intangible asset. Remember, with an indefinite life asset, there's no amortization. Recently, the FCC decided to auction these licenses to the highest bidder instead of renewing them. Archon Radio expects cash flows for the remaining 2 years of its existing license, so only 2 more years. It performs an impairment test. It determines that the fair value of the intangible asset is 1.5 million. What is the amount of the impairment loss? And let's record that journal entry for the impairment loss. Okay, so let's put down the information that we have. We know that the carrying value is 2 million, and we know that the fair value is 1.5 million. So with the fair value test is we take the difference between the carrying value, as long as it's higher than fair value, impairment is needed, minus the fair value of 1.5. And as long as this difference is positive, in other words, as long as the carrying value is greater than fair value, the amount of the impairment is the difference. $500,000 or 500,000. And that journal entry, same accounts as we used before, debit loss on impairment, and credit, in this case it was a license. And that concludes our information on impairment of intangible assets other than goodwill.